7 ways to invest in a crypto bear market. It may sound a little harsh to generalize along those lines, but as the saying goes, even a fool can make money in a bull market. The proof of how good a trader you are lies in how good you are navigating a bear market. This generally agreeable rule of thumb is applicable across all markets, not just crypto. However, with the kind of volatility crypto usually undergoes, the risks and difficulties brought along by a crypto bear market tend to be on a much higher scale. And as we witness the possible onset of another crypto winter, with most of the popular coins knee-deep in the red, it's time we optimize our trading/investment strategies with the following tried and tested ways to survive crypto bear markets. What is a bear market? For those out of the loop, a bear market can be best defined as a prolonged drop in asset prices, which then causes your portfolio to shed value. In a bear market, the supply of an asset is typically higher than the demand because a large chunk of investors, known as bears, starts offloading loss-making assets from their portfolio, fearing further price drops. 1. Stay calm and assess your options. Whether you see the bear market as an opportunity to buy the dip or find falling crypto prices a bit too stressful to handle, always try to keep your calm and assess the situation objectively. Emotional decisions are the ones that you will most likely regret down the road, especially if you're trading. First, start by asking yourself why you are invested in crypto in the first place. Do you believe in crypto's long-term success and want to tap into the many opportunities that it could bring along? Or are you just here to earn some quick bucks doing short-term trading? The answer to this question could be your stepping stone to figure a way out of the bear market unscratched. 2. Don't try to time the bottom. Nobody, absolutely nobody, can accurately predict the bottom. You could study technical and fundamental analyses all you want or listen to experts, but at the end of the day, you may still have to rely on your gut feeling while trying to time the bottom. And as you will probably agree, gut feelings are not much of an option if you're looking for strategies to navigate a crypto bear market, or worse even, a crypto winter. You may buy at what appears to be the bottom at a given time. However, the price could further drop. And if it does drop, you will have to sell it again to have your next shot at timing the elusive bottom. More often than not, this strategy will only cause your wallet to shrink. 3. Dollar cost averaging, DCA. Dollar cost averaging, or DCA, is arguably the best strategy that has proven to have worked exceedingly well, even during the toughest of bear markets. It is a simple but long-term strategy where you continue buying small amounts of an asset over a period of time, regardless of the price. For example, a DCA schedule will have you investing, say, $50 in Bitcoin every week, rather than investing $200 at once. You may make changes to your DCA schedule from time to time to meet your changing requirements. So, continuing from the example above, suppose you started buying $50 worth of Bitcoin every week 3 years ago. By now, you would have invested $7,850 in Bitcoin over these 3 years. Now, using a DCA calculator, you will find that the total value of your investment would currently stand at $21,777. That's a sizable gain of 177.42% percentage chain over 3 years. 4. Consider staking. When the going gets tough in a crypto bear market, and your portfolio starts shedding value left and right, staking comes off as a good way to earn a passive income from your crypto stash. Staking basically refers to the practice of locking away your coins on a proof-of-stake (POS) blockchain for a period of time and being rewarded for it. For those out of the loop, this detailed guide is a good place to start if you want to learn more about staking crypto. The best part about staking is that it increases the size of your wallet, even in a bear market. That way, when the bull market resumes, you start with more than you had previously. Besides, staking also lowers the possibility of panic selling because your fund is securely locked on a blockchain. 5. Avoid shorting in a crypto bear market. Shorting is a technique traders use to profit from falling crypto prices. That should ideally make it an excellent fit in a bear market when price drops are a common occurrence. However, you would find most experts advising against shorting Bitcoin and other cryptocurrencies because it could potentially lead to unlimited losses or liquidation of your position. This is a fundamental problem with shorting, and no amount of experience can prepare you for the rude shocks when things go bad. When you buy crypto, go long. You can never really lose more than the amount you have invested. For example, say you have purchased a BTC worth $100. So the maximum you could lose from that investment is $100. On the other hand, the potential gain, at least on paper, could be limitless. Think of a scenario where the BTC price increases so much that the $100 investment returns $500, $1,000, $10,000, and so on. It's just the opposite with shorting. If you short a coin at $100, the maximum you will earn from that trade is $100. However, if the price of the crypto starts increasing and the uptrend continues, your losses could pile up indefinitely. And if you short using margin, you will have to keep paying the interest charges on top of the original loss for as long as you choose to keep the position open. 6. Carefully assess the current state of the market. As of mid-2022, in the middle of the current bearish trend, Bitcoin seems to have found major support near $30,000. This support is expected to hold the fort for a while given that several big institutional investors bought within this range. Meanwhile, other indicators suggest that a big chunk of new investors who probably bought near the top have already sold most of their crypto amid fear, uncertainty, and doubt. Their exit from the market at this stage could further stabilize crypto prices. The point here is that it is important to stay updated and have situational awareness about the current state of the market. This way, you stand the best chance to position yourself accordingly, act quickly, and minimize losses. 7. Avoid leaving your crypto on exchanges. Like they say, not your keys, not your coins. This is applicable in pretty much any scenario involving a centralized custodial crypto exchange. However, the risks of irretrievably losing your funds stored in these exchanges become even bigger during a turbulent bear market. Consider what might happen if there was a sudden market crash. Billions of dollars would be wiped out from the market, causing many exchanges to end up insolvent. Always opt for a non-custodial wallet app, or better still, a tried and tested hardware wallet to have full control over your crypto stash. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.